Let me cut to the chase. 5%. That's been my net annualized return, adjusted for defaults on LendingClub. 5% return. 5% per year, in my opinion, is not that good. Hey everyone, this is Ian from ppcian.com. I am back with another video about investing. Today's video is a response to one of your questions from a while ago. I apologize for this one taking so long. I have such a queue, such a backlog of these responses, but they will all be produced. It will just take some time. I'm broadcasting today live from the beautiful Drake Park here in Bend, Oregon. Really beautiful spot between meetings on my business trip today, so I thought that I would take a few minutes and film this video about peer-to-peer lending. The question was just this: Ian, what do you think about peer-to-peer lending? How do you compare and contrast that to dividend growth investing? So I have been investing on the LendingClub platform, which is a peer-to-peer lending platform since 2011, so I've been on it for 6 years, and I have some perspectives on it, which actually differ from my perspectives when I first started. When I first started, I did a few blog posts about it. I thought the world of it. I thought it was amazing. I still think there are very many benefits to peer-to-peer lending, but I've changed my perspective a little bit. And so today I want to share the pros and cons. For those that don't know, peer-to-peer lending is when you lend money, you disintermediate the bank. You're basically lending money directly to other peers. So an example of this on LendingClub or Prosper is you can lend as little as $25 to someone out there who might need the money for a medical bill, for home improvements, for credit card debt consolidation, and you receive a good interest rate. And they receive a lower rate than they would get if they went to the bank. These platforms have been very popular because they advertise heavily on paid search, on the internet. A lot of people see them on social media. They've gotten a lot of press. Fun fact, I first got started with LendingClub because my old boss became the CEO of the company, and he's someone I think the world of, so that's a benefit of LendingClub just as a platform. They've got great management, great team behind them. So I got started. I've now invested over 1,000 loans on the platform over the years. Not all at once. I've phased in and out, and and some of these loans get paid off early. So 1,000 loans sounds more than it really is because a lot of them get paid off early, and then you just reinvest the funds. Let me cut to the chase. 5%. That's been my net annualized return, adjusted for defaults on LendingClub. 5% return. 5% per year, in my opinion, is not that good. I can yield 5% yield on cost in dividend growth investing pretty quickly. I can do that by buying a stock now at 3% yield, hold it for a number of years, watch them raise the dividend, and then it'll hit a 5% yield on cost. And then I'll get a 5% yield on cost in perpetuity, and it'll go up even more as they raise the dividend more. And that doesn't factor in capital appreciation. So after all these years yielding 5% per year, it's not that good. That being said, it's obviously a different asset class than dividend paying stocks. So can I really compare these things? Can I really compare the two? That's what it comes down to. I am comparing them because at the end of the day, my goal is passive income and cash flow. I want massive dividends that will surpass my living expenses that I can live off of. So I do have to compare and contrast them, but to be fair, they are very different asset classes. And peer-to-peer lending, I align it more with bonds than I do with stocks, but that said, they're both passive income vehicles, so I compare the two. What else? Peer-to-peer lending is taxed as ordinary income. Dividends are taxed as long-term, qualified dividends are taxed as long-term capital gains. Dividends have a lower tax rate as of now than peer-to-peer lending. So not only am I only receiving 5% net annualized return adjusted for defaults, I'm being taxed higher on it. And my returns have gone down over time. I've seen lower returns. And the reason for that is I've had more defaults over time because more time has passed. I would say something else just between dividend growth investing and peer-to-peer lending is peer-to-peer lending, I don't have time to research it. I just let LendingClub put the money in me automated. $25 at a time, it's not worth my time to research that. Dividend growth investing, when I'm investing lots of money in dividend growth stocks, accumulating over time, dollar cost averaging, I put a lot of research into it. I like the dividend growth investing path better. Another thing about peer-to-peer lending, you're only in these loans for a short amount of time, and that's a good thing because the longer the loan, in my opinion, the higher the risk of default or of the borrower defaulting. So most of the loans I issue, I'm in them for 36 months. It's a shorter term kind of thing, and then after 36 months, or if they pay it off sooner, I've got to find another loan. It's more of a short-term type of thing. Here's where it does get a little bit interesting is an emergency fund. Kind of view peer-to-peer lending right now a little bit as my emergency fund. There's a good amount of cash coming in each month just because they're repaying principal in addition to the interest that comes in. So you get the benefit of the principal coming in, which provides a nice little steady stream of cash. You can either reinvest it or use it. So I kind of look at it a little bit as a buffer. If I need to tap into that cash, I could. That being said, peer-to-peer lending at this point, it's less than 1% of my portfolio. It's, in dollar terms, there's some dollars there, but it's less than 1%, and I'm kind of at a crossroads. I'm kind of thinking, hey, should I just cash it out, put some of it in a real emergency fund, start the real emergency fund that I forewent. If you watched my other video, I consciously decided, hey, Ian, I'm going to forego an emergency fund here during the Great Recession because I want to get as much money into dividend-paying stocks as possible. But now, in 2017, I'm starting to build an emergency fund. I'm a family man. Maybe I build it from LendingClub. I just take the money out. Or maybe I take some of it out, the rest I put in dividend-paying stocks. I don't know if I'm going to do that or not. I'm at a crossroads, but I'm certainly thinking about it as I just analyze my portfolio, and I know that I need to stay focused. I need to focus on dividend growth stocks. That's my focus. That's where my financial freedom, my cash flow, my early retirement, all of that is going to come from. That being said, does peer-to-peer lending have a time and place? I think it does if it's part of an asset allocation strategy. I think it does if it's viewed completely differently as stocks. I think there's great platforms out there built on great technology like LendingClub, backed by great people like my old boss, who I think the world of. I certainly think there's an element of it of doing good, helping out your fellow peers. I like lending to people. I like disintermediating the bank and helping people out. I think there's an element of that to it, which is cool. So I think there are pros and cons, but I would say here for me in 2017, it's not a huge part of my cash flow strategy, and dividend-paying stocks are, and they're really everything to me in terms of personal finance. Quick disclaimer, today's video is not investment advice. It's just for your fun and entertainment. I am not a licensed investment advisor, and if you are going to go out and invest in the stock market, please do consult a licensed financial advisor first. I thank you for watching today's video. If you like the video, please give a thumbs up, please comment, subscribe. That means the world to me. And please keep the questions coming. These questions are amazing and they fuel the content here on PPC Ian. This is Ian Lopuck broadcasting here from beautiful Bend, Oregon, and I will see you in the next dividend investing video.